Happy Friday, everybody. We're still in for a really wild ride here with the markets. Things have been up and then down and then up again, and a lot of it does have to do back to the fiscal policy. And we're looking at two big things right now. Number one is what's called this big, beautiful bill, which is what the Republicans are trying to put through Congress to do two things. Number one, it's going to cut tax rates, right, and leave them steady where they are going forward. This also has ramifications for the estate piece of it. And what they're also trying to do is simultaneously cut some spending. The issue here has to do with magnitudes. If we really are serious about getting spending under control, we need to actually look at the places where there are high spending. For example, Department of Education, the budget is probably 30 to 40 billion dollars a year versus defense, which is over 800. If I'm trying to get rid of a deficit, if I'm trying to reduce spending, then doing things around the edges, nibbling around the edges of the Department of Education is not really going to help. And the markets have reacted to this bill negatively. And you can see it in the bond markets with interest rates. Interest rates are going up, and they're going up because that is the risk of lending money to the US government. The higher the interest rate is, that means that bond investors are asking for more in compensation from the government. And a lot of this has to do with the fact that our Congress will not get its act together to get our fiscal house in order. And this could be a big problem. The reason is because when we have high interest payments, money is going to interest payments that could otherwise be going to other productive capacities. So if you see interest rates rise and you wonder, geez, it doesn't really seem like we're in a recession. Well, it doesn't always have to be a recession that drives up interest rates. So I really do think that part of what we're looking at is high grade corporate debt, right? Bonds from companies that have the ability to produce cash flow. And we're also looking at nice municipal debt, right? Municipalities that have the ability to tax and have a strong tax base, what are called general obligation bonds. And we're monitoring very closely because as interest rates go up, bond prices come down. And so we have to be very careful about when we buy and sell things. So big picture here is we've got a bill that's working its way through Congress that is going to cause more economic trouble than it's going to solve. And that is causing the markets to react. And so what we're trying to do when we look at your portfolios is to make sure that we are in a position to take advantage of higher interest rates. Higher interest rates means a higher return to you, while not sacrificing capital gains by selling bonds early, because as interest rates go up, the price of the bond comes down. If you have any questions, please reach out and let us know. We'll be happy to talk about your situation. I hope you have a great weekend, and we will be back soon.